Welcome to the National Credit Awareness and Resolution Association podcast at NACARA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use Creditor Tools, specifically problem loan administration. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Problem loan administration. For any variety of reasons or circumstances, there will always be problem, criticized, or classified loans. The root cause for credit deterioration may come from the debtor's operations, market conditions, competition, or management's decisions. Maybe the issues were exasperated by weak, in other words, credit risk management practices by the lender. Problem loans may be baked into when the loan was first originated, such as new startup businesses, speculative ventures, insufficient collateral margin, or lack of equity in a property, dealing with borrowers who lack character, poor underwriting on the level of debt service repayment ability, failure to obtain adequate financial statements, not understanding the loan purpose or borrowing cause, failure to recognize market demand, like a building lot bit for building lots concentration and lot absorption rates, or a favorite, too much focus on income and fees. The creditor needed the loan totals, right? Problems happen, especially when there's an economic downturn. Loans that need such special attention will generally be transferred to the Special Assets Department for resolution. Next, credit policies, risk ratings, and monitoring reporting. Financial institutions have well-established credit and lending policies and procedures to identify early and administer problem loans. If the creditor is paying close enough attention, it will be able to spot changes that need to be addressed. Management will have established policies to guide their expectations on how it intends to manage adversely risk-rated or problem loans. Criticized loans are risk-rated and generally referred to as special mention. Criticized, special mention. And now, classified loans are risk-rated substandard, doubtful, and loss. Criticized and classified loans are also referred to as just criticized loans too. Creditors readily know that when financial performance is off, including collateral values and other metrics, creditors focus heavily on managing problem loans in a timely basis, including individually documented problem loan action plan reports. Those are updated perhaps every month or every quarter that detail the overall steps to get your loan upgraded back to a pass rating, an acceptable pass rating, or to a zero balance. And that includes possible liquidation of the entire credit. Another tool is the disposable loan modification. Regulatory guidance changed in December 2022 that changed the way regulated creditors reported and disclosed impaired loans, heretofore called troubled debt restructurings or TDRs. The new disclosure requirements for certain loan modifications is called DLMs, to borrowers experiencing financial difficulty, or disclosable loan modifications. These modifications include 4 criteria or any combination thereof to be assigned as DLMs. Number 1, principal forgiveness. Yes, you heard that right. That's a possibility. Principal forgiveness. 2, interest rate reduction. Yes. Number 3, other than insignificant payment delays. Okay. Or number 4, term extensions. Again, these can be any given item or a combination of items. DLMs show the 4 ways a creditor can participate with the debtor in developing repayment strategies. Loan forgiveness may include a charge down of the amount owed to a lower balance, which helps with the ability to repay on the remaining balance. The difference can be repaid after the first portion is repaid. Like there's a note A and a note B. They split the note in half and charge the back part off. And then it can be repaid once the first part is repaid. The interest rate in a favorable workout situation could be reduced, or payments temporarily deferred, or the term extended. Keep this card in your back pocket. Maybe put it in your front pocket. Now, next, creditor due diligence, workout and forbearance agreements, liquidation, and bankruptcy. Creditors will search to verify whether there are recorded judgments against the company and its principals, including tax liens, especially federal tax liens that may supersede the creditor's interests, and secured junior liens by other creditors. Generally, and especially if the debtor is cooperative and is submitting the required financial statement information, a creditor will be able to gauge how solvent the company and its owners are, and how much longer they will be able to remain in business before having to file bankruptcy. Beforehand, however, a creditor may enter into a workout agreement to repay the unpaid balance that summarizes certain negotiations, and will be binding, of course, on the creditor, the debtor, and the guarantor. The rights in the remaining loan documents beyond the terms and conditions of the workout agreement, they remain unchanged and are not waived. A creditor may also enter into a forbearance agreement where it will forbear taking further action in exchange for the debtors doing certain things. A creditor may exercise its rights to offset money that the debtor has on deposit at that institution. In rare instances, a creditor may discount the promissory note and sell it into the marketplace, and thus be repaid usually at a hefty discounted rate, and the balance would be written off. Of course, the creditor may have no choice but to turn to the collateral, for example, to foreclose on the real estate, or by taking back a deed in lieu of foreclosure for an agreed-upon amount to satisfy the debt. Or they could pursue a non-judicial foreclosure in states that use deeds of trust, or a judicial foreclosure, like a court proceeding, against the property and the guarantors. If everything fails, a bankruptcy petition would likely ensue. Let's talk a little bit about self-dealing. Once in a while, there is self-dealing where unsound credit is given to insiders, or credit granted by certain lending personnel with incompetencies for specialty lending. The board and senior management may also fail to provide effective oversight, all the while there are changing economic conditions. Lenders often rely on oral or written information from debtors instead of verifiable information. Competition may also play a role, as creditors will be tempted to compromise their credit standards and loosen loan covenants, etc. Institutions have been known to implement aggressive loan growth strategies for what ends up being short-term growth in earnings, but later on with a heavy portfolio of problem loans and charge-offs. It's like letting the kite string out so far that when the line is pulled, nothing happens. They can't even see the kite or control it anymore. Such risks are clearly unwarranted, of course, but it happens all the time. Documentation errors have historically been the cause of material problem loans, but the quality of loan documents has improved greatly over the years. Let's talk about a notice of default, an interesting tool here. At some point in the problem loan process, a notice of default may be recorded against the real estate collateral. The creditor will likely list all the conditions for which the default issues were based, and the debtor will be required to remediate each one of the conditions before the default may be cured. For some conditions, the unpaid loan balance may even be accelerated, and a full payoff amount will be required, usually within 10 days, else the creditor may elect to pursue its legal remedies to collect the unpaid balance, including the liquidation of the collateral. Prudent creditors are likely not going to ignore any conditions of default, because they realize that the sooner they address these problems, the better chance they have in achieving their least loss, if any. The longer they ignore these conditions, the more likely they are to incur more losses, as the ability to repay and the conditions of the collateral usually deteriorates. This short ad is sponsored by the Debt Crisis Problem podcast. Attention, listeners. Please join us at tunabudget.com to tune in to the Debt Crisis Problem podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. So why is all this important to you? When it's too hot in the kitchen, people scatter, and the creditor will then call the shots. And examples of problem loan situations include payment delinquency, multiple renewals without the usual payment structure, evergreen loans where little principal reduction is required, declining credit metrics, minimal or deficient working capital, lower trends and high aging in accounts receivable and inventory levels, increase in accounts payable, declining revenues, increase in expenses, heavy debt to worth ratio, and most importantly, poor cash flow. Okay? It gets hot and people scatter. And when repayment problems are present, the required financial reporting is often generally lagging on the part of the borrower. Borrowers just like you, they may go into hiding. They scatter. So if you experience diminished cash flow, collateral issues, or your financial performance is off plan, you could expect that the creditor will be formulating its own action plan to shore up the credit. It's been that way for decades. The creditor is going to call the shots, including fixing any structural issues like enhanced financial performance covenants, more reporting, and collateral, etc. However, is this the best solution? Next, develop your own workout plan. Of course, creditors will work with you to find a prudent repayment solution, but this is where the paradigm shift takes place. You need to be the primary author of the so-called workout plan with your own quantifiable measures and completion dates. Use your pro forma cash flow statement to show, even if the numbers are low, the available cash flow to keep you in business. Your efforts to find a solution with a creditor clearly demonstrates your willingness to remain committed to the financing. Use the Disclosable loan modification tools, the DLM tools, to your benefit if need be. This is the new regulatory guidance, the latest guidance for most regulated financial institutions. There are 4 measures for consideration or any combination of these measures, okay? Principal forgiveness, interest rate reduction, other than insignificant payment delays, and term extensions. Using these tools is still safe and sound lending that is also prudent. Be wise as you prepare your recommendations, but these are tools for your use. Go through the front door and communicate with what you may need to stay in business. It will be apparent, quite frankly, that you are not committed to your loan if you avoid the creditor or make any threats to the creditor. Now, if legal threats are made to the creditor, you can pretty much guarantee the creditor will turn that matter over to its attorney for legal action against you. Don't make such threats unless you intend to keep them. Creditors can tell where you are, commitment-wise, so there's no sense in trying to hide your real intentions. As you look for repayment solutions, be open to a workout plan. The lender will also offer loan modification terms and solutions. Consider what changes may need to be made via an extension of the loan terms, maturity date, interest rate, payment amount, collateral, guarantees, etc. When there's no viable source of repayment, a loan can be restructured into 2 notes. This is called a restructuring, an A and a B note. In other words, your note is split in 2. And the A note will remain on the books, and the B note will be charged off. Doesn't mean you don't owe it, you still do, but it'll be charged off the lender's books and repaid after the A note is repaid. Perhaps the B note can be set at a 0% interest rate. You can ask and propose anything. Be sure to use the DLM tools to your benefit as you propose a debt repayment plan. Next, you should make every effort to repay your loans in good faith. In the end, if it's entirely impossible to do a workout, then so be it. It can be a cooperative liquidation in good faith too, as this will keep everyone's time and costs down. Creditors have even paid their borrowers to help with the liquidation process to recover as much as possible for the creditor. A liquidation budget can be established, and you should be part of that process too. The cost savings means less will be owed to the creditor too. So don't be surprised if, when you approach your creditor, there are new people assigned for the administration of your loan relationship. All products and services you have with a creditor will likely be under the approval of a workout department or assigned to a new team in the Special Assets Department, SAD. SAD is comprised of workout specialists as opposed to the usual primary relationship officer or the relationship manager on the loan production side. The latter may have a potential bias and be predisposed to taking actions that may not be in your best interest as opposed to the creditor's overall best interest. In fact, SAD officers are more independent and will have the creditor's interests first and foremost, I can guarantee you that. Having a problem or classified loan in a primary loan officer's portfolio does not fit financially well with this officer. Transferring the credit to another party like SAD, where it makes most sense, this will increase the chance of a faster and more favorable outcome to the creditor. A new SAD officer should be more objective and have more time for you, so seek a mutually acceptable outcome by preparing your own debt repayment solutions. The SAD officer will likely engage with you in good faith and help you get the job done. Thank you for joining us today. We've covered another creditor tool, problem loan administration, as debtors prepare to propose their own repayment solutions. We want to hear from you, so share your own credit risk memo and debt repayment experiences, questions, and recommendations with us all at nicara.org. If you found today's episode helpful, please also subscribe for notifications of future podcasts. Your feedback helps other small businesses also stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.